Hello to everybody. My name is Stuart Podmore, as you've heard. This is my first visit to Gibraltar. And I love it. I've got to say, I'm not quite sure why I haven't been here previously. So I've already texted my family to say we're going to come back here without a doubt, although my daughter has actually played hockey here on a hockey tour and she thoroughly enjoyed herself. So I'm very pleased to be here. And I hope also that you are too. Thank you very much indeed for giving up your time. We've got a very important partnership with Trusted Novus Bank, and we relish that opportunity to work with them. So in working with you today, I'm very pleased, obviously. But this is the first time, I've got to say, this is the first time somebody's introduced my slot as a market outlook and then twisted it, stuck it on its head and said, actually, none of that really matters. So, if you want to catch up on a bit of sleep for the first part of the presentation, maybe you can. But actually what I would argue is that thinking about markets and macroeconomics and thinking about our behaviours as a result of all this stuff is really important in combination, in conjunction. So feel free to ask questions at any point in the presentation as we go through it. This is a market outlook, but it's through a behavioural lens. So just have that in mind. The first part of the presentation is best opened with a quotation. Things that have never happened before happen all the time. Isn't it funny that we always seem to think that the challenges or the disasters or the tough times, welcome, please come along, the tough times have never happened before. We always think that at this point things are at their worst or at their most challenging. And actually when you've lived a bit of a longer life, you realise that looking back into history, human beings are facing challenges all the time, and we have always done so. So be prepared for things to happen, actually, that have never happened before in your imagination, but actually do. And the best way of illustrating that, I think, is this index. Has anybody ever heard of the GPR index? The Geopolitical Risk Index. That's what you're looking at. Some of you might be new to it, some of you might not. But I'm addressing geopolitics straight away because I know that many people in this room, if you're anything like me, will be worried about it. We have war in Europe, we have war in the Middle East. It is an extremely challenging time. This is the GPR index that was first introduced back in 1985 by two former economists in the Federal Reserve in the US. And with a combination of language models and spotting words which indicate that tensions are rising across about, like I say, 12 publications, they are able to transpose that into a GPR index. And what you see in the blue line is geopolitical risk as measured by the index. What you see in the green line is something called the VIX. Now, the VIX is a proxy for volatility. It's a proxy for expectations of volatility. Expectations of volatility across markets. So let's just concentrate on the blue line first of all. Anything strike you about that blue line? Say anything about that blue line that you observe immediately. Feel free to do so. Because I think this is quite important and will resonate with people. As the title of the slide suggests, we're trying to bring a modicum of objectivity to this to avoid perhaps that rising sense of panic that sometimes comes when you think of geopolitical risk rising.
There's a frequency to it.
There's a frequency to it. Expand on that, sir. As you munch on your popcorn.
Well, it's quite illustrative with global shocks and particularly conflicts within the world.
Yes.
And they all seem to attract the same amount of response for high impact, high risk because of that.
Absolutely. Thank you very much for speaking up, by the way. That's great that you've spoken up, and it makes it so much more interesting for all of us. So I thank you for that. And you're absolutely right that actually there is a frequency to this. Do you remember the quote? Things that never happened before happen all the time. Things happen a lot when you look back at history, and we haven't put everything on this chart, have we? But you look at those various incidents or conflicts that have caused the geopolitical risk index to spike, and there is a frequency to this. So that should be, in a way, some reassurance to investors that things like this do happen all the time. Sadly, this kind of thing is normal. And by the way, I'm not wishing to undermine any of the human tragedy associated with anything on that slide. Similarly, and I've helped you out here, there is something else to point out, that before the 11th of September, before the trade towers, that average was lower. Subsequently, it's higher. Not by a huge amount, but you could argue, you could say to yourself, well, actually we are living in a riskier environment. That much we should reflect upon. And then I think one of the things that you also hinted at is that when these spikes do occur, they spike very sharply indeed. So there's about 3 things you can draw from that chart by only looking at it for about 5 minutes or so, which I think brings some level of objectivity to your thoughts about geopolitical risk. And that's what we're trying to achieve here. We're trying to avoid being drawn into an emotional response that says the whole thing is awful and I need to get out of markets or I will not invest in markets. When you think about some of the market gains that might have occurred for clients and investors over that time, and yet still some awful things were happening. So that's the first point I'd want to make. This is a very busy slide which I'm not going to talk through, but we did a study in 2019 where we put together some portfolios and we looked back at 5 key geopolitical risks. When we looked back at them, we discovered that in terms of market behavior, geopolitical risks obviously caused that spike, but as you saw from the blue line, it was very concentrated and a temporary impact. Did you notice also that it fell very quickly indeed according to the geopolitical risk index as well? So yes, we know that the temporary impact is significant. Yes, we know that that lowers asset returns and stock prices. And under those conditions, we discovered that actually a safer portfolio will outperform. But I put it to you, how many of you might be able to be in that safer portfolio and not enjoy the returns that are on offer for the rest of the time? How many of you would be able to move quickly enough in order to move ahead of the kind of spikes that I showed you on the previous slide? It's extremely difficult to do that. And that takes me to the green line, which is the VIX index, the expectations of volatility. The green line does not always move in perfect harmony with the blue line, does it? So markets are sometimes being moved by other things as well as geopolitical risk. So put all of that together takes me to the second point, that when we looked across an extended period of time, we found actually that investing in what we described at Schroders as a riskier portfolio gave you a better return in 4 out of 5 of those periods we chose. And then finally, that the dynamic portfolio we put together actually gave you a better risk-adjusted return. So the answer is not necessarily number 1, I go into a safe portfolio or I take my money out of markets. It's not that, although the emotions are telling you it should be. Now, as well as the geopolitical environment, I want to also talk a little bit about longer term trends. We are observing, in our opinion at Schroders, what we describe as a regime shift. For the last 10 or 15 years, rates have been suppressed. Loose monetary conditions awash with cash have prevailed after the global financial crisis and also through the pandemic. Governments have been extremely active. We think at Schroders, however, that that's changing, and we call it the 3D reset. The 3D reset. And we think when you look back at the trends from the previous 10 or 15 years, the trends looking forward are going to be quite different. And they're going to be driven by these 3 Ds. First of all, deglobalization. We are starting to see a change in the nature of the way the world operates. Deglobalization. Previously, for 10 or 15 years, particularly with China's influence, we saw the world becoming far more connected, did we not? Cheap goods being moved around the world for the benefit of societies of wishing to own those goods. That was the story. Very low interest rates, and things felt very connected indeed. Clearly, the pandemic had a big part to play in deglobalizing, and people are changing their supply chains. They're under pressure, not just from what I described earlier through the pandemic, but also, of course, through conflict at the moment as well in certain areas of the globe. We also saw greater levels of insecurity around war in Europe when we talked about the grain that was not coming out of Ukraine, for example. And now we talk about the oil that's now under pressure when it's coming out of the Middle East. So deglobalization, important trend. Decarbonization, do I need to say anything about that? We know we need to decarbonize. In terms of the Paris agreements, and by 2030, 2025, we have numerous deadlines that we have to try and meet for decarbonization. And then finally, demographics, that we know we're living in aging societies, certainly across the UK, similarly across Europe. Which country do you think is the most under pressure when it comes to the demographic profile? Japan, yeah. Japan, an aging society. Absolutely. I was talking to my colleague John Carter, who's here today, about Japan and some of the challenges they face. People running out of money into their 90s and, dare I say it, committing crime. because they've run out of money, and committing crime because they have nowhere to live. That's a tough society, and that demographic trend is also starting to appear in China. I heard last week on Radio 4 in the UK that China's population went down by 1 million people in 2022, and that doubled. It went down by 2 million people in 2023, so that trend is there too. You put those 3 Ds together and you have a higher inflationary environment. A trend, not just a short-term view, but a trend where inflation is higher. That's in essence what we believe about the 3D reset. And if inflation is higher, you then typically have an environment where rates will need to remain elevated in order to bring that inflation back down. And that's a longer term trend because demographics is destiny. I can't remember who said that. Auguste Comte, I think. Decarbonisation and deglobalisation. And some of which we have on the chart here supports it. Central banks will prioritise and are prioritising inflation over growth. You're aware of the central bank decision from the Federal Reserve and the Bank of England yesterday? There's evidence of central banks prioritising inflation over growth. Fiscal policy likely to be more active. New world order. I'll come on to that in a moment. Labour shortages. Demographically, we've got fewer younger people to do stuff. We have debates about migration at the moment, sometimes quite intense and emotive debates, but we know there's a labour shortage out there, so therefore technology is going to be required to help us get through it. And we know that that response to climate change has to accelerate. So that's the 3D reset. And the New World Order that I describe, I suppose, is focused very much around conflict, although previously it was catalysed by the pandemic. We saw, of course, the UN voting to expel Russia from the Human Rights Council in 2022. We've seen the Houthi rebels firing missiles in the Middle East at shipping and trying to tie what they are doing currently in the Middle East to the situation in Palestine, backed by Iran, according to many commentators. But there are fault lines forming across this world, and this will have a longer lasting impact, I think, on those supply chains that we had previously been used to up to the pandemic. You think about the disruptive effect that has taken place across those supply chains. And if you have to change your supply chains, if you have to source other providers, well, then that's going to add cost, isn't it? Hence the reason why we believe it to be more inflationary than previously. Don't forget also that if I'm changing my supply lines and I'm changing my suppliers and I'm changing some of the components I use, what does that imply from an investment perspective? As with everything, there will be some winners and losers in this newly shaped world. So already we can see that as some of those supply chains are changing, there are some beneficiaries. Certain economies like Mexico, for example, and Brazil have been beneficiaries of this changing, deglobalized world. So in some respects, deglobalized is perhaps a little bit of a misnomer. It's a re-globalizing, a change to the supply chain. We do see evidence of that. We look at corporate reports a lot at Schroders, and we've noticed that the mentioning of these phrases, nearshoring, onshoring, reshoring, look at that, going up in corporate reports. We're on the word count there. Significant now that that is occurring in many of the reports that we look at. We see it in the headlines. Apple India iPhone output. Apple to start making MacBooks in Vietnam. Lots of other opportunity there to bring evidence for what I just said. And I mentioned climate change and the inflationary effect. At the economics group in Schroders, we looked at climate change impact. If we take no further action, look at the inflationary effect of stranded assets, of reduced asset availability, and look at the impact on growth in green. If we delay that transition, again, an inflationary impact. Net zero, growth, model versus inflation, and then net zero with, critically, innovation. But what's the common bar on each of those elements of the bar chart? It's inflation. It's inflation. And again, to my point about demographics, it matters for governments, does it not? Because if your age dependency ratio on the left-hand side of this chart is rising, and look at all of these different countries that are experiencing a rising age dependency ratio, with an aging population, of course, the aging population is relying on fewer people to work and to produce growth. And typically, those people in older populations are probably spending less, and therefore growth is going to be restricted structurally. And we see that across the population levels as well, where they are falling. So macroeconomic outcomes, it looks a bit bleak in a way, doesn't it? Higher inflation for longer, labour shortages I've described, the challenge to globalisation. Greenflation is a phrase that people use. We know that there's going to be tighter monetary policy. A good example only this week. Rates are being held. There is still quantitative tightening going on as well in the Federal Reserve as well as the Bank of England, and a need to reduce that inflation. One thing I haven't mentioned yet, and even when I was talking about geopolitics, is the idea that populist politics might increase as a result of this. That actually people will start to think, I've had enough of this challenge. And various politicians around the world are now creating what you might describe as the populism siren call once again. And I'll talk a little bit in a moment about how that might impact fiscal policy, where governments are a little more, shall I say, active. What we do see here, though, is low market tolerance to fiscal largesse. Think back to October 2022 and the Truss government in the UK and what that did to gilt yields as a result of what you might describe as fiscal largesse. Global supply chains changing, energy policy changing, bringing more cost into those supply chains. And finally, and this starts to look a little bit more positive and a bit more exciting, the solution that is represented by technology. It has to help us increase our levels of productivity in the future and meet some of the challenges that I've described. In the shorter term, no market outlook would be complete without an estimate or a forecast on the direction of growth and inflation. At Schroders, we believe on the left-hand side of this chart that world GDP will be around 2.2% in 2024 and into 2025, somewhat subdued. And similarly, we do believe that inflation at 3% or thereabouts is going to be a little stickier. But this is a 12-month forecast. This is not a longer-term trend such as I described earlier. But it has been our belief around the 3D reset that inflation will remain a little higher than people have perhaps expected, and that interest rates, whilst they might well come down in 2024, will remain elevated compared to where they have been in the previous 10 or 15 years. And that's a key point. We do believe that the US economy, towards the end of 2023, was heading for the soft landing, and that actually meant that markets got way ahead of themselves. The last 9 weeks of 2023 saw a remarkable surge in markets, and that was on the expectation of what, do you think? That we were done with that challenge of inflation and that rates could come down. That's what everybody expected. Then we had a big hangover in January. So that's the big decision. The big decision really that is affecting markets in many respects at the moment is where are we on rates? Where are those decisions going to go? And it has been our view at Schroders that unlike the markets which were pricing in rate cuts for the Federal Reserve and for Europe as early as March, we felt that was not right. And we felt that they would stay and remain elevated at 5.5% and 5.25% respectively until potentially the summer and the autumn of this year. And that, it would appear, is where Jerome Powell, the chair of the Federal Reserve, has signalled they will stay, only this week. Now, what about investors? What about you? What about clients? Us? We do a global investor survey every year, and I thought it would be just quite interesting to show you this before we get into some behavioural observations. It would appear that everybody who answered our survey, 26,000 people around the world, responded to it. 78% agreed that higher inflation and interest rates meant, or they agreed with us that that meant we were in a new regime. Interestingly, look at the two middle percentages here. 54% have changed their investment strategy in the light of this. 34% intended to do so. 88% of people having an intent at the very least to do something different. I applaud that, because when you think back to the 10, 15 years of low rates and high liquidity, awash with cash, it's a different regime, and therefore you would, of course, have to change the direction of your investing. Except that I was convinced looking at the data in 2023, that many of those people actually were moving to cash. They went back into deposit-based savings accounts that might have been offering them 5-6%, may well be on offer through debentures here in Gibraltar. Tempting though that is. And yet 42% of people in our survey said they felt the returns for the next 12 months were going to be higher than the last 12 months. So if you're going into cash and you believe that, 42% of people believe that, why are you going into cash? I don't know the answer to that. But it has to be behavioural, does it not? And if you're going into cash, then let me ask you another question. When do you think it's going to be right to come back out of cash? Because that is one of the most difficult behavioural questions to answer for any client, any investor, any person in this audience. If I'm sitting on the sidelines, when do I get back in? Tough question to answer. Hold that thought. Okay. Right, so now we've gone past the physics stuff, although I would argue everything's about behaviour, even the decision to set interest rates. Remember, the Monetary Policy Committee has, 12 individuals around the table? That's got to be about behaviour, has it not? Diversity of thought? Well, maybe I would argue there should be a little more diversity of thought around that table, but that's a discussion perhaps over a drink afterwards. This is what it's about. Any physicists in the audience? One of my worst subjects at O-level. I've just revealed my age, of course, by calling it an O-level. But add feelings to this stuff and it gets really interesting. So, once again, I've got another question for you. Thank you very much for answering the questions so far. Here's a question. Don't think too long and hard about this. A notebook and a pencil cost $11. If the notebook costs $10 more than the pencil, how much does the pencil cost? Give me an answer. $1? Thank you very much for anyone who said $1. I feel like an auctioneer. $1? $1, thank you, madam, well done. $1. Final chance. 50 cents. Oh, okay. Interesting. Gold star. Gold star. If you said $1, you're wrong. I said $1 when I first saw this challenge. Intuitively, it looks like $1. Some of you sitting there saying, hang on, notebook and pencil, $11, $10. Can you not take $10 away from $11? It's $1. You're probably thinking, give me a harder question. Next question, please. Yeah, so algebraically you could represent it, but you're absolutely right. The answer is 50 cents. It's 50 cents. If the notebook costs $10 more than the pencil, but together they cost $11, you can sort of see the logic of that, right? It's 50 cents. 50 cents plus 10.50 is $11. But intuitively, you think it's $1. As I did when I first saw it. Take heart if you got it wrong. Take heart, because more than 50% of students at Harvard, MIT, and Princeton also got it wrong in something called the cognitive reflective test. And I'd imagine there's some pretty bright people in those institutions. Any graduates from any of those institutions in the cinema tonight? You probably don't want to reveal that fact right now, do you? Just as a quick aside, when they conducted this study, they had a control group which looked at much smaller font size. Do you think the error rate reduced as a result of the smaller font size or increased? In answer to the question. Reduced or increased as a result of a smaller font size?
Increased.
It decreased. Counterintuitive once again. Because guess what? If it's smaller, I know for one that I'm at least going to have to put my glasses on. What's going on there is that you are having to pay more attention. Suddenly you've got to look more closely at this. I suppose there's an argument in a way for marketing collateral, Kate, to be a really small font size, because then at least people will look at it. But that's, again, behaviourally, it's absolutely debatable, isn't it? But this is the point I'm trying to make, that Daniel Kahneman, the godfather, one of the many godfathers of behavioural finance and the thinking around behavioural psychology, identified, if you've read some of his work, that we have two systems in our brain, system 1, system 2. System 1, automatic, quick, little or no effort. System 1 answered the question, first of all, did it not? $1. System 2 allocates attention to effortful mental activities. Highly diverse operations require that attention. So for those who got the 50 cents, I would imagine you are capable of utilizing system 2, taking a little more time to do so, or maybe you've seen the question before, who knows? But you got the right answer. And that is really the essence of what Daniel Kahneman was thinking about. They work together. They are not to be judged, and they do lead in conjunction with one another to what people describe as behavioral biases, cognitive and information processing, and then similarly emotional and mood. And that is the essence of how the human brain works. What he said in his objectives here were two things. He wanted to improve our ability to identify and understand the errors of judgment and choice that relate to that arise from that. Now you can start to see perhaps when you think about markets and you start to overlay this thinking, you start to think, hang on a minute, system 1 or system 2? System 1 should not be ignored. System 1 actually can help us very often in life and can help us establish good positive shortcuts as well as negative errors. But he says actually an accurate diagnosis of this might well suggest an intervention, and then we can limit the damage that bad judgments and choices often cause. And there is some damage out there. So we need to recognize that having an understanding here won't take damage away, it won't eradicate damage. Sometimes you will lose money in markets, but in the longer term, overall, you'll have a better chance of reaching your life goals and your objectives for yourselves and your families. It sort of sounds easy, doesn't it? But it's not. There's a huge framework of what we would describe as behavioral biases. The Chartered Financial Analyst Charter covers these. They're split into cognitive errors, like I say, knowledge, understanding, thought processing, belief, perseverance, confirmation bias. The idea that you look around for confirmation of your pre-existing views. We do that so much, don't we? You decide upon your opinion and then you seek out the evidence to prove yourself right. I do that all the time when I'm at home. Similarly, availability, whatever is immediately available to us, will influence our decisions. And similarly, emotional biases, the idea that no one likes to make a loss. And I understand that, but sometimes in your desire to avoid losses at all costs, you could end up introducing greater risk into your portfolios. Overconfidence we see very often amongst fund managers just as much as everybody else who's investing in markets. The price of thinking you know more than you do. So those are the biases. And you can conduct what you would describe as an exercise in definition to understand what those biases are. You can then assess what the impact might be on your portfolios, and then you can go through a mitigation process. So to illustrate some of that, I've got an example on the screen. I worked for Barclays for a number of years, and I remember when the stock price was £7.20. Gosh, that's going back, isn't it? These shares were part of my remuneration. There's plenty of blood, sweat and tears in this holding, and I want to wait until I can make a profit. Now, I know I've skipped through the behavioural biases, but just don't worry too much about the biases. Just look at that statement and think about it from the perspective of behaviour. So a client, a fellow investor, has just said that to you over drinks. What would you think about that?
It's never a good time. Or it's always a good time.
It's always a good time, or never a good time. So in reference to, would you say that immediately? Would that be what you say?
The obvious one would be basically that obviously the price is low. You think it's a fear of missing out.
Yes.
So you have one in terms of trying to go on the bandwagon. You say, okay,
yes,
let's take the opportunity.
Yes.
Or the reverse, you say, maybe I'm too late.
Yes. So the herding bias is something that you were just starting to describe. Do you see evidence of that in this statement? I suppose you could argue that, yeah. That actually the Barclays stock price, as I picked a random example here, the Barclays stock price is £7.20. I want to be part of that. I have a fear of missing out on that. Yeah, that's perfectly valid. Anything else? Thank you.
I think it displays an emotional response that lacks objectivity.
Yes, I would entirely agree with you. Who else thinks that's an emotional response? Yeah? So we're back to the chart, aren't we? We're on the right-hand side of the chart here. So we're looking at loss aversion, overconfidence. Typically, you could argue that all of those biases are present, actually, in this particular example. So we talk about anchoring as well, although a cognitive bias. You understand what we mean by anchoring. As soon as you see a number up on that chart, you know that that individual is anchored to that price. £7.20. You can't forget that number. Now I've told you £7.20, you'll never actually forget it in the context of this presentation, if you remember the presentation. But the emotional response there is significant. What about that phrase, blood, sweat and tears? What does that tell you? What do you think this individual is saying with blood, sweat and tears? He's emotionally invested in it. He. We didn't say it was a he, did we? Interestingly. Okay, but he can be he for this. He was emotionally invested in it. Makes a difference with investors, doesn't it? That if this individual here, for example, has earned that money, that individual might think a little differently about or feel differently about the money as opposed to winning it or inheriting it. Worth bearing in mind. You're right. It is a male investor because it's me. I said it. Bit of a trick, that, isn't it? We could have gone on forever about my emotional response to this, but every single thing you see on that chart is true. So remember the global financial crisis? How could we forget it? The subprime mortgages crisis was coming across the Atlantic and it hit the UK. And I was sitting on a fair amount of Barclays stock because I used to work for the company. And Bob Diamond, I think the then CEO, reassured the market that Barclays was okay. So it fell significantly in terms of its share price, but then it recovered to £6.80. What do you think my wife said to me at that point? Yes. Yes, you're laughing. She said, sell. What do you think I said in response? This is uncanny because it's almost as if you were present. How do you know these lines? And I said to her, no. In fact, to my eternal shame, I said, don't be stupid first. I'm the guy in the market. Let's wait until it gets back to 720 is not the right answer because you can anchor to arbitrary numbers too, behaviorally. 7 is a lovely round number, isn't it? So I said, let's wait until it gets back to 7. Entirely arbitrary, but I was anchored to that value. It's lucky in some cultures, I'm told, but not in ours. At what price do you think I stopped looking? It's called myopic loss aversion. At what price do you think I stopped looking at the Barclays share price? 250? Thank you, sir. I would take that tomorrow. In fact, I'll take that price this evening if it's on offer. £2.50. Any advance on £2. We're back to the auction again. Any advance on £2.50. I stopped looking at the Barclays share price when it hit 57 pence. Yes. Okay. Yes. Now, we were living in the back garden at the time, actually, because we were refurbishing our house. 2 kids under the age of 5. And it wasn't easy. If you think about refinancing in 2008, imagine how tough that was. And my wife said, borrow an extra £5,000 and invest it in Barclays. And what do you think I said to her this time? I didn't say, don't be stupid. I'd absolutely learned my lesson by then. I said, no. That's far too risky. At 57 pence, Barclays stock was a steal. We knew that the government wasn't required to back Barclays Bank. We knew that private investors were stepping forward. We knew that it was going to avoid being nationalised, unlike RBS or Halifax Bank of Scotland as they were at the time. Too risky. Actually, in many respects, at 57 pence gave me an enormous margin for error with fresh investment. It just changes your perspective on the whole thing, I think, that story. And there are plenty of biases. I stopped looking at the Barclays share price, by the way, when it went past £3. And, well, over a drink, you can ask me if I've still got the stuff. But I think the point is well made. So, when you're thinking about much of this, behaviourally, you can inform decisions. You could say to yourself, for example, working with the cognitive errors, do I prefer 55% or 0.55 of current income? When people are asking you, if you're dealing with advisors or relationship managers. That was a Dutch study. Which of those two do you think makes you feel like you've got more money in your retirement in terms of income? 55% or 0.55%? The behavioural study found it was the decimal. 0.55, which I thought was quite curious. People feel in different ways. Will Vladimir Putin still rule Russia in 12 months from now? Those who think yes, raise your hand. Those who think no. A good question to ask yourself, do you really know? Behaviorally, good questions to test yourself with. And what convinces people to save more for their retirement, do you think? More than anything else, according to our Schroders surveys.
Closer you are to the age of retirement.
Say again?
Closer you are to the age of retirement.
Is not the right. A very sensible suggestion, by the way. This gentleman said the closer you are to your age of retirement will convince you to save more, which in a way is counterintuitive. It's the wrong way around, of course. Fear? That's a good suggestion. It might well work for some. What we discovered was people finding out that friends or the person down the road or a relative was investing more than they were for their retirement. So there are behavioural insights that can nudge us forward in the right direction, that can work very much and mitigate some of the behavioural biases that you saw in the Barclays example, and can remind us that actually it's very difficult to predict much of this stuff. So, to conclude, this is a great quotation actually from back to Daniel Kahneman, his book Thinking Fast and Slow. The easiest way to increase your happiness is to control your use of time. The time to be able to decide what you want to do, when you want to do it, with whom, wherever. Isn't that what we're sort of after here for financial security? I do appreciate that we share many of the same wants and needs, but I think it's worth remembering that and fretting over the direction of markets, fretting unnecessarily about the geopolitical direction or the GPR index without that modicum of objectivity, perhaps is a waste of time and energy in the context of what I'm trying to say. We asked people in our Global Investors Survey which investments have become more attractive over the last few months. Interestingly, active managed funds was the first point, private assets and digital assets. So to finish with in this part of the presentation, I just want to touch on some of that. That actually people are thinking that with all the challenges out there and the volatility that I described, being active and taking those opportunities, taking opportunities that present themselves in the form of behavioural biases in markets might well be worthwhile. And the idea of further diversification to private markets as a source of return, and digital assets, of course, being such an important part of what we know we need to do, i.e. invest in technology, as part of my points about the 3D reset. Markets are risky in the short term, less so in the long run. It's worth reminding everybody of that, first things first. So we're investing for the long term. This is 96 years of data, and we looked at the percentages of time periods where stocks and cash have beaten inflation between 1926 and 2022. These are holding periods at the bottom of the chart, 1 month, 3 months, and 20 years. So in other words, you could pick any 20-year period within the last 96 years, and you could be 100% confident that investing in large cap stocks will beat inflation. Cash only manages it 2/3 of the time. I think that's a startling reality as presented to us by history. A startling reality. Pretty much over 1 month is level pegging. We know that markets, through thick and thin, have delivered stronger long-term returns. Again, across the last 96 years, look at how large caps and small caps, for example, and even government bonds have outperformed cash. Look at the last 5 years in particular. Now, I know we're in a changing environment. We're into a 3D reset where inflation and rates are going up. But nonetheless, the longer-term trend is very clear. That actually strong long-term returns come from markets being invested in spite of the uncertainties that I've described. If you want another way of illustrating this, here's another question for you. Over the 102 years between 1896 and 1998, the Dow Jones Industrial Average rose from 41 points to 9,181. What would you estimate as the level of the index with dividends reinvested? And I'm going to go back to my role as auctioneer again and ask you, what am I bid? I had a go at this myself as well. I just need a number. The index went up from 41 to 9,181 across 102 years. If you didn't reinvested the dividends from that market, what would you be sitting on now? What would that index level with dividends reinvested? 25,000, an opening bid, very good opening bid. I thought 20,000 or thereabouts. You sort of want to double it, right? You're thinking about the compounding effect here, of course. 100,000. Thank you for being so bold. Excellent, excellent answer, actually. Very good answer, but not the right answer, once again. If anyone gets this right, you can have my car. As soon as I mention my car, we've got people leaving. I'm not buying his car. My car is currently parked up at London Heathrow. It's available if you get it right. 200,000 is not the right answer.
No, factor of a million.
Would you have ever got anywhere close? I try to shift my car every time I use this slide. You should have asked me which car it is, actually. That's a remarkable thought. A couple of things you might be thinking right now. 102 years? I'm not going to be investing for 102 years. That's long-term investing, right? Well, let me put it to you this way. 102 years for future generations of your family is nothing. I'm looking at my kids 19 and 17 years of age right now, and a lot of what motivates me currently with regard to markets and investing, aside from Barclays shares, is the fact that we're investing for the long term here. And I want them to enjoy those kinds of things in life in the future and enjoy themselves. So I'm thinking about that compound effect of reinvestment. You might also be saying, well, I'm not always going to be reinvesting those dividends. I might need them. Of course you will. But again, just think about compounding for part of the time. That's a remarkable number. And you've got the biggest edge there is in investment, the biggest edge over all the professionals. And I can talk long about the professionals. The biggest edge you have is time. Use it. AI will be more profound for humanity than fire or electricity. You agree with that? The changes from this technological revolution would be bigger than the industrial revolution. Do you agree with that? Yeah? I've got CEO in brackets question mark. They wrote an open letter to get him back, didn't they, the CEO? You know, I did wonder whether they got ChatGPT to write the letter. It's kind of interesting. What about this statement? This is the most important technological advance I've seen in 40 years. If you had to believe one person out of the three, who would it be? You'd go with Sam? I'd go with Bill. 40 years. I mean, you've seen quite a bit here. The reason I'm putting this up is because in terms of time and the future and the 3D reset and the technological advances that are required for productivity and to solve some of the challenges, you've also got to be aware that not just investing over the long term, yes, that's important, but also being wary of that herd mentality when people start making statements such as this. You know, these are big statements, and I happen to agree with them. But in investment terms, the situation is far more nuanced. And I would argue that getting professionals to look into the environment, the private, the public markets, the tech stack, the different services that different companies in the AI space will be providing, that is where you eke out value for investors. 95 minutes per day, 151 minutes per day. Do you remember the title of this final section of the presentation? Control your use of time. There might be some people in this room who also remember what it was like to make a mobile phone call back in the 80s. One person to make the call and somebody slightly out of shot to hold the briefcase while you did so. 95 minutes per day. What do you think that refers to? The average time internet users spend on TikTok. Who's on TikTok? Put your hand up if you're on TikTok in this room. Thank you for being so honest. You're in a group of one. Not now, two. But just think about it. In order for us to get to an average of 95 minutes per day, and no one's on TikTok in this room, That looks nothing like normal distribution, does it? That's how people are spending their time. 151 minutes per day is the grossed up social media time spent. Control your use of time. It gets you thinking, doesn't it, about how we spend our time. What I would argue is I'd remind you of Joseph Schumpeter, an Austrian economist, who said that at the heart of capitalism is creative destruction. That is what so much of this is about. And investing and being invested is right at the core of human endeavour. I think in a way, knowing that you are putting your money at risk into markets because you know that in the long term you'll outperform inflation, in the long term you'll stand better chances of outperforming cash, and in the long term you're contributing to evolution, albeit it includes TikTok, and the idea that time is on your side is actually quite compelling and helps you overcome some of the short-term behavioural inhibitors that I've touched on today. That's the key point. Because what I would argue to finish with is that we are normal investors. None of us are rational investors. In other words, we are all sharing certain needs. We want protection from poverty. We want prospects for riches. We want to nurture our families. We want to stay true to our values. Very important when it comes to sustainable investing. I think if we admit it, we like the idea of high social status. And given that we're Gibraltarian and British, we love fairness. Those are the things that drive us. And yet, for so long, we've been entirely concentrated only on the utilitarian outcomes. Grow wealth, protect wealth. Well, yes, of course, returns are very important. That's what we're here to do at Schroders alongside Trusted Novus Bank. But actually, in the future, my thoughts about the behavioural will include the idea that you have expressive needs as well, that you have emotional needs and outcomes. In simple language, what that means is you want your investments to say something about you. You want your investments to make you feel in a certain way. And I think that's going to become more important in the future. And if you do that cognitively with advice and with relationship managers, you might find that you're able to control your use of time. And that, as we've heard, is key to happiness. My final thought is this, a behavioural chart that I stumbled across in 2019. This was data originally run in 2017. It simply answers the question, how satisfied are you with your life nowadays? Imagine if I ask you that question. No, I could ask you that question over a drink. And if you're still here after many drinks, it might change, but who knows? This was run across 51 countries, 1.3 million random selected people, and it produced 7 data sets. And here they are. Here are the lines. From the age of 16 up to 90. And there it is. That's the meaning of life, is it not? It coincidentally forms a rather nice smile, doesn't it? Now, I know what you're doing at the moment. You're placing yourselves on that graph, are you not? Okay? So I showed my daughter this at the beginning of lockdown in 2020, when she was 16 and stuck at home facing GCSEs. And I said to her, I'm afraid, Beth, it's all downhill from here for a bit. And she turned round, sharp as a tack, and said, at least I'm not grumpy and miserable like you at the age of 52. I leave you with that thought. That actually, when you put that together, bearing in mind that was across many different geographies, a very simple question, randomized control, but sample group, randomized samples, it always presents itself as fundamental to the human condition. And when thinking about investing in markets and leaving that money in markets invested over time, you're recognizing, with guidance and help, that these years are actually a bit tough. You're trying to establish yourself in a career or building your own business, starting a family, moving house. We all seem to do all of those things, and I remember that being quite difficult in my 30s. And similarly, it might explain your attitude to wealth and investing after what I describe as the pit of misery. By the way, they refreshed and reran the data in 2019. The pit of misery previously was about 52, so I was right in the pit in 2020. It's now, unfortunately, come a little further forward. So a few of you, I'm looking at you thinking, yeah, you think you've escaped it, actually. It's going to hit you soon. 47 is now the age. David Blanchflower, former member of the Monetary Policy Committee, put this research together. And the fact that it applies to all of us all over the world, I think, gets right to the heart of expressive and emotional needs, as well as the utilitarian. How you spend your time.
Who are the red line?
Uh,
Where are the red line?
It's not a particular group. It is a group of people, but it's randomized. So it's not an older group of people or a younger group of people. They randomized that so that there was no bias. And what they're trying to get to is the fundamentals of why we change over time and how. We could debate that all night long, I think. Ultimately, with relationship management and with investment advice, I think you get a lot closer to be able to accelerate that positive change. It says something about you and you feel good about it at the same time. Well, thank you very much indeed for your participation. Thank you very much indeed for listening, of course, and to those of you who've answered many of the questions. I hope that has been a useful spark for thought and discussion, perhaps over drinks. I am, of course, alongside Kate, very happy to take any further questions that you might have that relate to the macroeconomic and market outlook, as well as the behavioural material that I shared with you. So please take that opportunity if there's time.
Thanks, Stuart. That was a journey. It's very philosophical. They have a couple of questions that people have pre-submitted. You have covered some of them in the presentation. I'll start with the more philosophical ones so that we don't straight back into geopolitics. But you've talked about AI. So what emphasis does Schroders give to AI and the hype that's been around AI and the related stocks, particularly recently?
Oh, that's a great question. Thank you for asking that. We place an awful lot of emphasis on it, and we spend a lot of time thinking about it and give it a lot of our attention. The reason for that is because many of the startups and the venture capitalist organizations that are making groundbreaking progress in the world of AI at the moment are, of course, available only in private markets. So through Schroders Capital, we are very active at determining what is going on and the dynamic of those markets. We think we are very well placed to understand because we know quite a few of the business owners anyway. We know some of the supply chains that are involved in this, and we have a unique opportunity alongside other private equity partners, for example, to get a decent amount of insight. Similarly, we work on public markets as investors and analysts across a range of different strategies. What we're finding at the moment actually is that with AI, the private market and the public market present very different opportunities across that entire tech stack. So whether it's the apps that you might see on your phones, where at the moment that's quite an interesting space for private equity, compared to some of the infrastructure and that NVIDIA layer, if you like, that tends to be more interesting from a public market point of view. Although prices have been very elevated. NVIDIA gained, 230% last year? So the world of AI is very rapidly changing, and we pay a huge amount of attention to it, such to the point where we have our own closed AI system within Schroders now for all the employees. So when I'm writing presentations and when I'm working with AI, I use it quite extensively. And the other thing I should say is we have a lot of advisory clients in the UK as well, and we're finding that AI services are now coming to those businesses. We are not introducing those AI services, but a lot of advisory companies are now using AI for client reviews, for client meetings. I can see this continuing, but once again, behaviorally, we just need to be very careful of the hype.
Moving to politics, we've obviously got two big elections coming
Yes.
up, the US, the UK. Talk about Trump again.
Yes.
It's like déjà vu.
Yeah. Okay.
What are your thoughts of the impact of what those elections might bring
Yes.
to the
Okay.
markets?
Shall we start with? Let's start with Trump. I mean, the Iowa primaries and caucuses, New Hampshire. It could well be that Trump is the nominated presidential candidate for the Republican Party a little sooner than we discovered that to be the case in 2016. So that's my first thought, that this could very much be a Trump-Biden runoff once again, and it could be pretty tight. What we might expect from Trump, well, he started to give us pretty much indications of that already. So we know that the corporation tax or corporate tax rates were slashed under Trump. And actually, some of those corporation taxation rates are up for review in the next 12 months or so. So to a degree, I don't think we'll see quite the volatility in the reaction of markets that we saw in 2016. Because we know that some of those tax cuts are still in place. We know they're up for review. And he's already said, I think, that he's going to continue with those tax cuts. So I think there's a little more that's going to be priced in, and therefore I expect less of a volatile reaction to that. A bit more is going to be priced in, and a second time round we can anticipate it. However, I also heard General Sir Nick Carter, the former Chief of the Defence Staff, who I interviewed recently, say that he thinks that the US presidential election is the single most important geopolitical event in terms of risk that there is over the next 12 months, which I think we have to bear in mind. And that's partly because of relations with China. It's partly relations with Putin, of course. And it's the, dare I say it, unpredictable nature of Donald Trump as well. That is, of course, assuming that the courts don't intervene in some way. I mean, I heard BBC Radio 4 talking about this, the idea that he could be sworn in from a prison cell. Can you imagine? So that's the US. And I think whatever happens there, it is highly likely that you will see bond yields rise and that you will see a strengthening dollar. I think that's one key thing that markets have recognised. There is going to be a stronger dollar if Trump gets in. The UK, shall I talk about the UK very quickly? Yeah, we've heard that in terms of polling, the Labour Party is looking likely to win the next general election in the UK. Keir Starmer's popularity is nowhere near that of Tony Blair in '97, it's worth pointing out. He's viewed as competent, but a lot of people see him still as a blank canvas. They don't quite know what he stands for. Rishi Sunak is currently representing a brand that is tarnished, it's fair to say. And in fact, the Conservative Party, in the most recent discussions we've had at Schroders with Professor Matthew Goodwin, who's a political commentator and professor at the University of Kent in Canterbury, says that currently the Conservative Party is polling lower in terms of popularity than Prince Andrew. So I think
tarnished was quite a generous description.
that was probably a generous description. What you are seeing at the moment is the courting of business and financial services, the active courting of business and financial services by the Labour Party. In fact, there's been a meeting and a paper released only in the last 48 hours. So many of the leaders are getting together with Rachel Reeves and Keir Starmer. But many commentators are also saying, whatever happens, the UK government is going to face a tough environment. It's going to have to raise taxes. Nobody is being honest about that across the political spectrum. And a lot of people are saying, don't forget, the Labour Party might well not be quite as good for the economy as many people imagine, based on past experience.
Last question, because we are running over, but just to go back to that behavioural element, we are seeing higher rates in cash that is tempting people away from markets. So why should people, given all the geopolitical risks, consider investing in the markets rather than just sticking their money in a nice 6%, 5% deposit?
Yeah. Or do you want me to go back to? Do you want me to go back to?
No, forward, sorry.
Oh, okay, that way.
I'll just add, because if you go forward, no, to the end, after the disclaimers.
Oh, yeah.
We have a weekly market update as TM Bank, so there's a QR code that if you want to subscribe, you do so on your phone. There'll be QR codes at Boyd's as well. Sorry.
Just on cash, I mean, life after cash. Okay, we know at the moment that rates are going to stay a little more elevated than perhaps people has anticipated. Central banks prioritising inflation over growth, such as I've said. But the siren call of cash is important in any overall balanced portfolio. A cash reserve is essential to all financial plans. We know that. But actually sitting on the sidelines, you are potentially victim to a kind of paralysis. And we know the direction of travel here. We talk a lot about a soft landing, but actually some commentators are now starting to think that might manifest itself as recession, even in the US. Many commentators, including our own economics team, believe there will be a recession in Europe and the UK. And under those circumstances, those changing situations, then actually we're back to the long-term benefit of markets. That even through recessions and even especially through recovery, then being active and investing at that time can sometimes be defining in the longer term for your investment returns. The one thing I got right was investing in March of 2009. I think the FTSE 100 was at 3,700. I can't even remember what cash rates were at that point, but for me it was a very straightforward decision at that point with my last £3,000.